Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Anushi Vakharia, and we're going to discuss an infra company today, or rather, railway-specific company. Titagarh Rail is what we're going to break down today. And yes, there are a couple of changes, which is why we're bringing Titagarh back fairly quickly on a KYC to redo this and try and understand as to how the picture for FY26 looks like. I'm going to start off with what I want to know, and yes, there's plenty of tailwind with regard to this sector, but there is one concern: wheelset availability. This has been a bit of a drag with regard to where numbers are concerned, especially where Q1 is concerned. There's expected to be a recovery in Q2. How certain is that recovery is what I'd want to know. What the full impact will be, will it completely come only in Q3, and therefore will Q2 numbers also remain slightly on the subdued side, is the other piece I'd want to know. So those two things is the first part of what I want to know. When does that recovery come through? The second piece is with regard to the execution run rate for full year FY26. What does that look like? Because the order book is tall, so there's no concern where the order book is the case, but it's only about execution ramp up. So that's what you want to really look for, and therefore how will FY26 numbers look like, and versus the consensus, how do they look like, and what the risk to the delay in delivery will be. They have seen some of those translate in the past, where deliveries are which were supposed to happen did not happen for a multitude of reasons, and now is there any risk with regard to FY26 and FY27? So those are the two pieces. The third piece is the split between passenger and freight. Now there's going to be a big shift. They've been doing freight for a fairly long period of time, and freight is roughly 90% as of FY24 financials, 89%. Passenger was just 11% back then. FY25 actually things got even worse, where freight was a larger piece of the pie and passenger was even smaller. But margins in the passenger side went up quite substantially in FY25. That is expected to likely continue to improve, along with the skew towards passenger going up as well. In fact, the order book breakup as well now has a larger portion of passenger, a lesser portion of freight. So I'd want to know both of these angles. Does passenger now start commanding a higher share very, very quickly? Is that what the ground reality is? And what the margins will therefore look like in passenger versus freight, right? Now, the fourth piece is with regard to the Mumbai Metro Line 5. There has been some chatter that they are L1 bidders to Mumbai Metro Line 5. I want to know what the visibility is like. When do we get that full visibility, whether they've won it or not? And what will it bring to the table in terms of value? Around 2,500 crore is what the number seems to be hovering around. When does execution for that also happen? Because that takes the order book substantially higher, adds another 10% to the cumulative order book, including the order book of JVs. So that's quite substantial, and 20% to the current standalone order book. So that's quite substantial. And the sixth piece being the export business. Now, the domestic business of a Titagarh Rail faces plenty of pressure, especially from a cash flow perspective, because largely government orders is what they service, and therefore cash flow is back-ended. So it takes some time to translate. Export, on the other hand, is slightly different. It's a better business, it's got better margins, but it's less than 1% of the total business of Titagarh. Is that going to be a new area which they focus on, and whether there is visibility on that, or just that there is no bandwidth to take on export business? So some of those angles I'd want to explore when it comes to a Titagarh Rail. But let's start off with what the company does and give you a perspective on an absolute basic perspective on what it does. One, it designs and manufactures rail and metro systems, wagons, as well as ships, even though shipping is frankly very, very small component, so I've virtually left it out of the product mix. The largest wagon maker in the country, it's got around a 25% market share. It's the only Indian private firm making both freight as well as passenger train wagons, and also active in shipbuilding, defense and bridges. which is now a separate subsidiary, frankly. Let's talk about products, and I'll focus on the main ones alone. Freight rail systems, which is the major revenue. It comprises of wagons for carrying goods, boxes, tanks, flats, etc. Right? It comprises of components, wheels, bogies, couplers, brake systems, loco shells, etc. And then you have customers. Who are the customers? The Indian Railways, private firms, and defense, but predominantly the Indian Railways. That's where a large part or the large chunk of the revenue comes from. Private firms is increasing, and there is a larger focus there as well. So private firms, export, better margins, better cash flow, all of that translates. Let me talk about passenger now. Metro coaches, urban city trains, semi-high-speed trains like the Vande Bharat, sleeper trains for long distance, and then you have propulsion and electronic systems, motors, converters, control systems, which is the core of the train. All of that is getting covered at this point by a Titagarh. The order book size is roughly 26,000 crore. 38% of that is freight, 62% is passenger, with a rapid shift towards passenger in terms of execution expected. Let's break down the order book as well. There you go, that 26,000 crore order book, largely coming in on a standalone basis, 12,500 odd crore approximately, and 13,500 coming from the JV side of things. So that's how you're adding up to roughly 26,000 crore in terms of order book. JVs are with the likes of a BHEL, my apologies, and an RK Forgings. Yeah. So both of those JVs is what they have. So that's broadly the take with regard to the business, I believe. And we'll speak with Mr. Umesh Chowdhary, the Vice Chairman and Managing Director at Titagarh Rail, in just a bit to get a perspective on some of the questions we have. But Anushi, we'll start off with the metrics as we always do. We'll start off with income statement, balance sheet, cash flow, return ratios, shareholding, street cred, street coverage, and valuations. We'll cover all of those angles. We'll start with Anushi.
Income statement as usual. So yeah, right now if you look at the revenue CAGR growth, FY25 was an outlier in terms of where the performance was concerned. In the last 2-3 quarters, we did see an impact of the wheelset availability impacting the freight revenue, which is a bigger contributor of the business. Hence, in terms of growth, what we are seeing is around flattish growth in FY25. But if we take the long-term picture in view, that's the 3-year CAGR rate, that comes up to 38%, and that's what translates in the EBITDA front as well. We are looking at a 38% of a CAGR in terms of where the EBITDA is also, and this is with margins mainly remaining in the likes of 11 to 12%. In just FY23, they clocked in about 9% of margins or so. Net profit also at FY25 stood at 275 crores, slight bit of dip that we're looking from the FY24 levels. Quickly walk through the Q1 numbers as well, since that was just what had come yesterday. In terms of how the revenue fared up, that was 25% of dip that we'd seen in the quarter. Again, this is on the back of the impact that we'd seen in the freight rail segment. But the management now expects this to normalize from the second quarter onwards, and that would be something that we should be addressing with the management as well. Margins more or less stood at 9.4% as compared to 10.7%, and net profit stood at 31 crore, or 50% of a dip that we are looking in terms of where the net profit is concerned. So, Harsh, this is the overall trend that we are seeing in terms of the income statement.
So, Anushi, we were also talking about the Italian business of Titagarh, and they've provided for that Italian business. Give viewers some color on that as well. Maybe.
Okay, so what the company has said is, like, currently they have a carrying value of around 112 crore or so, and other receivables of around 61 crore. This is as of the June 25 that we are looking at. There is projected impairment loss as far as where that is concerned, but outcome still awaited on this front. So currently, while in this quarter the impact is not determinable, it is something that we should be watching out for, right?
Absolutely. So they're saying that they're fully provided for this. So unlikely that there'll be an impact going forward with regard to this business. But so that's possibly a positive, some overhang going away. But let me talk about the balance sheet now. When you're looking at equity plus reserves, around 2,500 crores where that number stands. It trades at around 4.5 times price to book. When you're looking at the borrowing number, it spiked up. We've seen an inch up with regard to the borrowing, but you have enough cash and bank balance to take care of that. So the net debt is virtually near zero. which is a positive again. So no concerns with regard to where the balance sheet is concerned. It's a clean balance sheet. Anushi, cash flow.
Cash flows, if we are looking at in FY25, we are looking at a negative figure in comparison with FY23 and 24 stood at a little bit of stretch in terms of where the payables are also concerned, which has led to this number that we are seeing. In fact, if you look at the net cash flows, that stood at 304 crore. This is also in the negative that we are seeing. So hence for that, we have given a thumbs down for this particular rating.
Well, Anushi, give us some perspective. You know, these receivables continuously going up. Is that just the nature of the business? You track this space closely, so you have a great understanding of how these businesses work. Is that the nature of the business? Should we continue to expect that? Because this negative 450 crore of working capital is what's really hurting the business overall, right? Some of that because you have some of it sitting in inventory or still to be completed inventory. And some of it also because of receivables. Is that the nature of the business, or will we see an unwind on this?
So what we are seeing in terms of receivables, while FY24 was a bigger stretch in terms of where the receivables were concerned as compared to FY25, but with infra companies and railway businesses, we have seen that some bit of pressure coming in terms of where the receivable numbers are concerned. The question would be whether it's from the government side, if you are looking at in terms of this number, some bit of pressure that is coming, and we should be addressing this with the management as well in terms of how the cash flow picture is going to shape up going forward.
Perfect. So let's do that. Return ratios. And when you're looking at the return ratios, they didn't look as positive till maybe 2 to 3 years back. But FY23, FY24, FY25, seen very, very robust ROC numbers. 18, 25, 17, very, very strong. And yes, there will be more capex which will get done. Around 600 crore, if I've read correctly. A lot of that will be internal accruals as well. You want to talk a little bit about capex? You have a better picture.
In terms of where the capex, as the company has plans in terms of where the FY26, 27 is concerned, and this is mainly for the passenger rail that we are looking at. You know, the company in fact had a fundraise also just couple of months back. So of course they have stronger capex plans in terms of the current land acquisition plans also they have made. They're adding new verticals which would be accretive from FY27 onwards. So that is also something that we should be watching out for. But I'll walk through the shareholding pattern now. Now in terms of where the promoter holding is concerned, 47.8% was the stake that we had seen in March 23, which eventually came down to about 41% in June 2025. In FIIs and DIIs also we are looking at a change in terms of where the mix is, where in last 2 years DII's stake has gone upwards from 6% to 11%. Or so, while FII's shareholding has increased from 6% to 9.49%. But in March 25 to June 25, we've seen a dip in terms of both of these numbers which are concerned. Public holding now up till 38% is what we are looking at. So on the basis of that, we've given this one a neutral rating.
Yes, and the other piece with regard to shareholding is the number of shareholders. We track that closely, only from a perspective viewers, that you want to see whether there is a substantial ballooning of shareholders in terms of number, and which means that retail participation has substantially gone up in terms of fragmentation of participation, and that has happened where the shareholding pattern is concerned. So you want to keep that in mind as well while you are determining shareholding pattern. We've given this one a neutral with regard to where the shareholding is concerned. Let's talk about the street cred now. 1 month, the stock price is down roughly 13%. Of course, the stock has moved today, so not factoring that. 6 months down 4, year to date down 26, 1 year down 41. So across the board, you are seeing pressure. Stock is down 50% from its all-time highs, or near round about 50%. 5 years though, the stock has been a multi bagger. So clearly giving very, very solid returns to shareholders. And therefore, we've given this one, street cred, a neutral as well. Let's talk about valuations, Anushi.
In terms of valuations now, we've compared it with the likes of Chipter Wagons and Texmaco Rail. And what we are seeing is majorly, if you are looking at current PE, Titagarh around 39 times, Chipter also similar kind of valuations that we are looking at. But in 1 year and 2 year perspective, if you are seeing, we are seeing this coming down to 28 times if you are looking at the 1 year forward PE, and then eventually even moving down to the likes of 22 times. And I'm assuming that this is on the basis of higher deliveries that are expected for the passenger rail system, more capacity additions that is happening in the foundry business as well, even in the wheels business that the company is making. So it is interesting to see how that one plays out, right?
Well, yes, you have 27,000 crore order book,
Yeah.
not small by any standard, and therefore as that execution ramps up, you will likely see the earnings multiple compress and compress sharply. That's what's visible on your screen as well, and that will continue to happen. Let's talk about what analysts are suggesting on this one. 8 buy calls, no holds, no sells, with a return potential of more than 30% even after what the stock has done today. So strong in terms of street coverage, no complaints there. In terms of the overall rating, let's stack it all up, and that's on your screen now. You've got cash flow may be a bit of a concern, and we'll address that, but otherwise it looks overall either a thumbs up or a neutral, gets us a 5.5 out of 8 on our KYC ratings. Let's go across. We have Umesh Chowdhary joining us, Vice Chairman and Managing Director at Titagarh Railsystems. Sir, welcome. Great having you. I'm Harsh. With me is Anushi. Sir, let me first start off by understanding from you what's happening with regard to the ramp up on the wheel side of things, because that's dragging your overall numbers. What's the perspective? Q2 midway, what's the view? Is Q2 going to be that quarter where we're going to see a bump up, or the full throttle push with regard to execution will only happen Q3? Give us that perspective.
So good morning, and thank you for having me with you. I was very interestingly watching the analysis which was presented, and I must compliment, it was quite a thorough one. Coming to the wheel set issue, the problems that we faced in the previous quarter, and to some extent in the earlier quarter as well, was solely on account of non-availability of wheel set from Rail Wheel Factory, which is the undertaking of the Ministry of Railways. They had certain production challenges, and as we have written in our press note and also in our analyst call yesterday, investor call yesterday, that over the last 2-3 weeks, we've seen the problem of the wheel sets having gotten resolved. So I would say that end of July onwards, or beginning of August onwards, this problem seems to be a thing of the past. As far as our other production facilities, order book, everything is in place. So the only thing as far as the freight rail segment is concerned, the only hold up that we were facing was availability or lack of it for wheel sets, which is now resolved.
So, in terms of freight rail segment that you mentioned that these issues are now being resolved. So in FY25 we had seen an impact of this in the last 2 quarters or so, even in Q1 this playing out. So considering the flattish growth that we saw in FY25, what is the kind of picture that you have in mind for FY26? And also with passenger rail now in consideration, there is expectation of margin upticks in terms of how FY26 would be as well. So if you can give us a color on both of these fronts.
Absolutely. So as we have also given in our press note along with our results, we are confident of being able to make up the lost production of the Q1 in the balance 3 quarters. And we have given a guidance that the overall quantity of wagons that we are likely to deliver in the current financial year is going to be similar to what we have done in the last financial year. On an overall basis, now we have a capacity of doing between 1,000 to 1,200 wagons. But considering the overall market demand, the order book and all of that, we expect that ballpark of 900, so plus minus 50, 100 wagons here or there on a monthly basis is what we are wanting to or expecting to deliver over the period of time to come. Of course, as we have announced, the orders that we have as on this date is about 10,500 wagons, but there are new private sector tender pipelines or inquiry pipelines that have built up, and we are expecting the railways also to come up with their requirements either by the end of this financial year or thereabouts.
Got it, sir. Sir, talk to us a little bit also about the unwind on the cash flow side of things. There's plenty of cash blocked in working capital at the end of FY25 as I can see it. Is that starting to unwind Q1? When should that unwind happen? So therefore, will FY26 be a year where you'll have a large cash surplus coming through?
So we have two business segments, and both have to be seen separately. As far as the working capital cash requirement is concerned, the overall working capital cycle of the freight business is much shorter. The cash blockage happened in the last year primarily because the wheel set problem, which was more of an unexpected issue, happened over the last 2 quarters, or actually in the end of the third quarter and in the fourth quarter in terms of the FRS. And all our other production and inventory and everything was planned with full availability of wheel sets. So that was primarily the reason. Otherwise, if you see the earlier years, FY24, etc., the cash flow was positive. The operating free cash flow was positive. But we are confident of being able to bring back the overall cash need, the working capital cycle in the FRS to around 30 days cycle, which is what the ideal working capital cycle should be for the freight business. When it comes to the passenger, this is another story, and that is, we in the passenger rail segment, we have three SBUs, which we have announced in our press note. One is the Metro SBU, one is the Vande Bharat, and one is the propulsion and electrical. The overall cash requirement, working capital cycle in this business is about 75 to 100 days. And therefore, the working capital requirement will be higher. But also, when we are in the ramp up phase, we have to make sure that there is adequate inventory, because there can be slip up somewhere or the other. So that is not the key consideration to maintain the ideal working capital number of days at the ramp up phase of the company. But going forward, maybe in FY27, we will be able to come to that 75 days working capital cycle for the passenger rail system as well. So in short, FRS, we should be able to get to the 30-day working capital cycle this year. And in the PRS, 75 to 90-day working capital cycle in the next year.
Just more emphasis on passenger rail segment. Just want to understand from FY27 onwards, is there a shift expected in terms of where the freight rail and passenger rail is concerned? Because freight rail is currently a larger contributor, but now with the Vande Bharat prototypes, deliveries expected, more metro rail order wins also that you've declared, even the delays in terms of where the Bangalore Metro was concerned now easing off. How would the picture be for this particular segment? Because it's expected to be a pivotal driver for you going forward.
Absolutely. That's a very interesting question. And, I think it's very reflective in the nature of the order book that we have. I've always mentioned that the wagon business is at a cruising altitude. It is almost like I would say, annuity business now for us, because we have already got, even our foundry capacity expansion is now completed. We will be on line with production within this and the next quarter. So we'll be integrated in terms of the wagon to be able to produce between 900 to 1,000 wagons a month, subject to the ordering from the railways, of course. We have a kind of a very big change of volumes going forward. But passenger rail system is a completely different story altogether. So out of a total order book of 26,000 crore, including our share of the JV, only 4,000 crore is the freight rail system, and the balance is all the others. Now, this signifies a huge shift in the overall company's fortunes going forward, where freight, which used to be 95% of our revenue and of our order book, is now, in terms of order book, only 4,000 out of 26,000 crore. So that kind of signifies the kind of growth trajectory that the passenger rail system is going to offer, and how strategic that is going to be for the company in years to come.
All right. Thank you so much, Mr. Chowdhary. Unfortunately, all the time we have, would have loved to push this discussion more, further and try and get a better perspective. But sorry, sir, that's all the time we have on this edition of KYC. From Anushi, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.